Internal Revenue Service IRS tax news. New law extends COVID tax credit for employers who keep workers on payroll. IR 2021-21, January 26, 2021, Washington. The Internal Revenue Service urges employers to take advantage of the newly extended employee retention credit designed to make it easier for businesses that, despite challenges posed by COVID-19, choose to keep their employees on the payroll. So we have this kind of incentive. These incentives have been changing over time as we've been progressing through 2020. So you want to make sure that you're in compliance with the latest revisions of the law so that you're getting the full benefits that you can as you're going forward with it and making the best decisions that you can do going forward. So the Taxpayer Certainty and Disaster Tax Relief Act of 2020, enacted December 27, 2020, made a number of changes to the employee retention tax credits previously made available under the Coronavirus Aid, Relief, and Economic Securities Act, otherwise known as the CARES Act, including modifying and extending the Employee Retention Credit, otherwise known as the ERC, for 6 months through June 30th, 2021. So now it's going through June 30th, 2021. So several of the changes apply only to 2021, while others apply to both 2020 and 2021. So some of them are just going here forward. Some of them are then going back into 2020. So here we go. As a result of the new legislation, eligible employers can now claim a refundable tax credit against the employer's share of the Social Security tax. So we got a refundable credit against the employer's share of the Social Security. So not the amount that's coming out of the employee wages, but the employer's share of the Social Security tax. It's equal to 70% of the qualified wages they pay to employees after December 31st, 2020 through June 30th, 2021. So after December 31st through June 30th, 2020. So we got 2 quarters that would be involved in 2021 here. So January through June, half the year, 2 quarters, 6 months. Okay. Qualified wages are limited to $10,000 per employee per calendar quarter in 2020. So limited to $10,000 per employee per calendar quarter in 2021. Thus, the maximum ERC amount available is $7,000 because that's 70% of the $10,000 per employee. So the $10,000 max that could be eligible. So $7,000 per employee per calendar quarter. So every 3 months per quarter, for a total of $14,000 in 2021. Because there's only 2 quarters that we're talking about here, half the year, 2 quarters, okay? So employers can access the ERC for the first and second quarter in 2021 prior to filing their employment tax returns by reducing employment tax deposits. So the way I interpret this is you got this credit that could be coming when you do your 941 payroll taxes. That happens every quarter typically. For most people, they file their 941s on a quarterly basis. But you got this credit. So therefore, you want to get access to the credit sooner. How do you get access to the credit sooner? Well, normally, after each payroll, you then have withholdings from the employees, and you have the employer payroll taxes that you have to pay some point after each payroll period. And then the end of the quarter, the Form 941 is kind of like a verification form that's saying, hey, this was my payroll liability. This is the amount that I have already paid. Now, if you're going to anticipate that you're going to have a credit on the 941 at the end of the quarter, then they're saying you may be able to then to not deposit or pay as much of the taxes during the period to the government because you're going to have this credit that you're anticipating that you will then verify when you do the 941s at the end of the quarter. So my interpretation of it would then be that you're going to figure the credit, you're going to reduce the amount of deposits that you're going to make to the government by it, and then you're going to reconcile that with the 941 that you're going to form at the end of the quarter, which will then show the credit amount, and then the payment should line up if we got the calculations correct. So small employers, i.e. employers with an average of 500 or fewer full-time employees in 2019, may request an advance payment of the credit subject to certain limitations on Form 7200, Advance Employee Credit due to COVID-19, after reducing deposits. So in this case, you might say, okay, well, what if I figure my credit that I'm going to get and then I figure my deposits, and my credit is greater than my deposits. So even though I'm not paying in then the deposits there, I still have a bigger credit. Is there any way I can get in advance of that credit, or do I have to wait till the end of the quarter so I can fill out the 941 to get, a refund of the credit? And they're saying, well, in that situation, so first you look towards the deposits, number one, and then if that doesn't get you the full amount of the credit, then they're saying here for these types of employers, you might be able to qualify for Form 7200 to request an advance of the employer credit due to the COVID-19. There's a link to that here, again, rather than kind of waiting till the end of the quarter and then filling out the 941. So in 2021, advances are not available for employers larger than this. So if you're over that 500 or fewer full-time employees, then not available, apparently. Effective January 1st, 2021, employers are eligible if they operate a trade or business during January 1st, 2021 through June 30th, 2021. So the first 2 quarters of 2021 or the first 6 months or half the year, and experience either 1, a full or partial suspension of the operation of their trade or business during this period because of government orders limiting commerce, travel, or group meetings due to COVID-19, or 2, a decline in gross receipts in a calendar quarter in 2021 where the gross receipts of that calendar quarter are less than 80% of the gross receipts in the same calendar quarter in 2019. To be eligible based on a decline in gross receipts in 2020, the gross receipts are required to be less than 50%. So this is going to be obviously a rule looking at the decline, and basically the assumption then being if you had this massive decline, even if you weren't closed down directly, then maybe you're negatively impacted, and that would be then possibly cause to be able to be eligible for the credit once again. So employers that did not exist in 2019 can use the corresponding calendar quarter in 2020 to measure the decline in their gross receipts. In addition, the first and second calendar quarters in 2021, employers may elect in a manner provided in future IRS guidance to measure the decline in their gross receipts using the immediately preceding calendar quarter, i.e. fourth calendar quarter of 2020 and first calendar quarter of 2021, respectively, compared to the same calendar quarter in 2019. In addition, effective January 1st, 2021, the definition of qualified wages was changed to provide. So we've got this change in what are qualified wages in? That's kind of important. So in addition, effective January 1st, 2021, the definition of qualified wages was changed to provide for an employer that averaged more than 500 full-time employees in 2019. Qualified wages are generally those wages paid to employees that are not providing services because operations were fully or partially suspended due to the decline in gross receipts. For an employer that averaged 500 or fewer full-time employees in 2019, qualified wages are generally those wages paid to all employees during a period that operations were fully or partially suspended during the quarter that the employer had a decline in gross receipts regardless of whether the employees are providing services. Now, as I'm reading this, it looks like one of these 2019s to me possibly should be a 2020, but I'm going to keep pushing forward here. So retroactive to the March 27, 2020 enactment of the CARES Act, the law now allows employers who receive Paycheck Protection Program PPP loans to claim the ERC for qualified wages that are not treated as payroll costs in obtaining forgiveness of the PPP loan. So we've got this kind of situation, obviously, that we've got these different kind of benefit packages out there, like this credit here, and then the PPP loan and whatnot, and there's going to be some kind of overlap in terms of the qualifications for these items, and there's questions as to whether or not you can take both of the benefits based on the same kind of cost. So in other words, the Paycheck Protection Program was a situation where you can get, quote, a loan, end quote, but if you have certain expenses that are qualified that under the Paycheck Protection Program, they basically forgive you the loan, or it could be forgiven. If they forgive you the loan based on the expenses that are there, which could include payroll, then you basically got free money based on, the payroll, right? It's not really a loan in that case. It's just money. It's free money that was free as a loan that was forgiven. So then the question, of course, will be, well, if you got a benefit related to these expenses because of the Paycheck Protection Program, could you also qualify for some other, benefits such as a payroll credit based on the same expenses that you're going to be using. That's going to be, that overlap is going to be a question. So as you look into these types of things and these different options that are coming up, you want to think about the overlap that's going to happen between different benefit programs and whether or not the IRS is permitting the same costs to be qualifying for different kind of beneficial programs. So for more information, you could see the COVID-19 related employee retention credit, how to claim the employee retention credit, frequently asked questions, the FAQs. There's a link to that here. There'll be a link to this in the description.